Revenue and profit. This short presentation is going to look at the concept of revenue and profit and how it's used in business. One of the key technical terms that you'll see used quite a lot is the word revenue. Now, revenue is all the money that a business generates through selling their products or services. You calculate revenue by multiplying the selling price of the product by the number of items you actually sell. So, for example, if I sold 10 ice lollies at £2 each, then my total revenue would be £20. £2 times 10, £20. So all the money that comes in is revenue. This doesn't account for any costs. That's all the money that just comes into my till, so everything I've got. Now, there are various different sources of revenue. The obvious one that most businesses have is what's called sales revenue, and this is all the money you make from the products you sell. However, you may get interest revenue if you've got money in the bank and it's resting in the bank account gaining interest. So anything you get paid on the money that's in the bank is called interest revenue. You may also get loan revenue. Now, this could be if you take out a loan from the bank and borrow some money, or maybe a building society, you borrow the money off them to actually invest in your organisation, but it's a source of finance, it's a source of revenue for your business. Of course, the problem with loan revenue is it needs to be repaid and it comes with an interest charge, and that's a cost to the business. So in the long term, it's going to cost you more money. So the best one on there is sales revenue, because that is money you're generating from selling more products. If money's in the bank, then you could argue it's wasted, because why are you investing the money to grow your business? Now, there is a theory that you need to speculate to accumulate. So businesses need to spend money to actually make money. So, for example, a shop would need to spend money on buying stock. Because if a shop's got no stock in it, then nobody will actually go into the shop and actually try and browse to even consider buying an item. So you've got to try and attract those customers by making the shop look nice, so putting stock in there, spending money on a little bit of presentation, the way it's styled. You've either got to spend money on staff to make sure they can serve people quick enough to ensure that they're going to get through the checkouts and get a good reputation and image of the company. Just like a car dealer will spend money on advertising and the presentation of their showroom to make sure that people feel like they're going to buy that car, it's all shiny and nice. Now notice that's all spending money, that's all the cost, but you've got to spend a little bit of money to be able to make more money back, and that's called added value, where you can make more money back than what you spend. Typical ways that you can spend money in most businesses are things like utility bills, so that's like your water, your gas, your electric, they're called utilities. Your telephone bill. Maintenance costs, so looking after your building or your factory, or making sure that your machines are kept up to date and are working efficiently. Wages and salaries, so remember, a wage is a variable cost, a salary is a fixed cost. Your stock. Fuel for your car, or fuel for your heating if you've got gas heating. A loan maybe, so you're going to maybe have to spend on the interest repayments on that loan that you've borrowed money from. Advertising, because you might have to pay to advertise. Taxation, you have to pay tax, you have to pay VAT, you have to pay corporation tax, as well as your national insurance. And then of course you've got your insurance to insure your premises. So you need to make sure that you're covering these typical costs in your business. Some are more essential than others, some are more optional than others. But probably without some of those, you couldn't really operate your business effectively. Yes, you might save a little bit of money in the short term, but you'd attract no customers, so you'd go bankrupt in the long term. Now, it's important to remember that expenditure is anything that a business has to pay out, whereas this term overheads are the everyday running costs of an organisation. So your overheads are the running costs, like your gas, like your electric, like your telephone, where expenditure can be anything you pay out, any form of money we spend in our organisation. And that leads us to the term profit. Now, to calculate profit, we need to know the revenue and the expenditure of the business. And we calculate profit really simply. It's revenue minus costs. Now, we make a profit when our revenue is greater than our expenditure. So we have more money coming into the business and going out of the business. And we make a loss when expenditure is more than revenue. So we spend more money than we got coming in. And clearly, making a profit is good because we can invest that money in the business and grow the business. Making a loss is bad because we may need to borrow some money in the short term to cover our losses, which is going to cost us money on interest. In the longer term, we won't be successful. Okay, that's it. You should now have an understanding of what is meant by the terms revenue, expenditure, and be able to use those terms and identify different examples to to calculate profit for an organisation. Don't forget to follow me on Twitter at BeeBusinessBee and subscribe to my YouTube channel. You can tweet me any areas of business you want me to cover in the future, and check out my website for more resources and questions. It's beebusinessbee.co.uk.